Well, China, without a shadow of doubt, is the big beast in town, for the simple reason that the United States is not importing as much. Up and until last year, according to published statistics, the United States was the world's largest net importer of oil and gas. China has taken over that title, and the Americans, to be very honest, not too sad about losing that title. Now, what's happening at the present moment in time is that China has the buyer's clout. With US in general retreat from the international markets, the Chinese are the big beasts in town. All producers are looking towards China. What that does is that it gives China a lot of negotiating clout. Now, China has traditionally had good relations with OPEC, and what's happening now is that some of the African exporters are also now turning to China, especially Nigeria and Angola. So a lot of the participants in the oil markets are looking towards China and how it will fare. Now, I'll make you take things into perspective. If we go back to, say, 2010, 2011, refinery output in China was 10 to 11% higher than it is at the present moment in time. That's how it is. That said, I would still say that some of the refining players in China would see, would need more crude oil. They will see a rise in their consumption patterns, but it won't be in double figures. We're kind of looking at about 3 to 5% uptick in consumption by Chinese refiners. And that in itself it's not massive, but it can sort of lend support to the oil price. Now, in terms of economic data, China is sending very mixed signals. We get the odd set of good data, we get a couple of sets of flat data. I would see that changing later down the year. So in summation, I would think the global oil markets they're heavily reliant on China, purely on the basis that the US is not importing as much.